Have you ever wondered exactly how many dividend stocks you need to retire early? What if I told you that owning too many could actually slow you down, while owning too few could leave you struggling to make ends meet? In this video, I'm breaking down the perfect balance: how to build a portfolio that's not only manageable but also maximizes your passive income. Stick around because by the end, you'll know the ideal number of stocks for your retirement goals, and I'll share a bonus strategy that could supercharge your plan. Let's cut to the chase. The ideal number of dividend stocks for most investors falls between 15 and 30. This range gives you enough diversification to minimize risk while keeping your portfolio simple enough to manage. But here's the catch: it's not just about hitting a number. It's about building a portfolio that aligns with your goals, lifestyle, and risk tolerance. Let's break this down step by step. 1. Why diversification is key. Diversification is like a safety net for your portfolio. If one stock takes a hit, say a company cuts its dividend, you don't want your entire retirement plan to crumble. By owning stocks across different sectors, you reduce the impact of any single company or industry's performance. Here's an example. Imagine you only own energy stocks. If oil prices crash, your entire portfolio could tank. But if you also own dividend stocks in healthcare, consumer goods, and tech, you're spreading out the risk. Think of diversification like having multiple backup plans. If one fails, the others keep you afloat. But here's the thing: once you own 20-30 stocks, you've already captured most of the benefits of diversification. Studies show that adding more stocks goes beyond this point has diminishing returns. So instead of owning 100 stocks and barely knowing what's in your portfolio, focus on holding a smaller number of high-quality companies. 2. How to pick the right stocks. Now that we know diversification is important, let's talk about quality. The key to a successful dividend portfolio isn't just owning any dividend stocks, it's owning the right ones. Look for companies with a strong history of paying and increasing dividends. These are called dividend aristocrats, companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble that have paid and increased their dividends for 25 plus years. But don't stop there. Look for companies with a low payout ratio, typically under 60%, meaning they're not overextending themselves to pay dividends. This makes their payouts more sustainable. Combine this with strong cash flow, low debt, and a track record of steady earnings, and you've got yourself a winner. Here's a pro tip: mix dividend aristocrats with high-yield stocks and dividend growth stocks. The high-yielders give you immediate cash flow, while the growth stocks ensure your income keeps up with inflation. It's like having a balanced diet. Each type serves a purpose. 3. Calculating your passive income needs. Here's where it gets personal. How many dividend stocks you need ultimately depends on your income goals. Let's say you want $50,000 a year in passive income. If your portfolio has an average yield of 4%, you'll need a total portfolio value of $1.25 million to hit that goal. Now divide that by the number of stocks you want to own. With 25 stocks, you'd need to allocate about $50,000 to each position. With 15 stocks, it's closer to $83,000 per stock. The point is, the size of your portfolio determines how much you invest per stock, and by extension, how many stocks you'll need. 4. Avoiding over-diversification. Let's address the elephant in the room: owning too many stocks. While diversification is great, over-diversification can dilute your returns and make your portfolio a nightmare to manage. If you're juggling 100-plus stocks, you're essentially replicating an index fund, but without the simplicity or cost efficiency. Here's a relatable analogy. Owning too many stocks is like trying to follow 100 TV shows at once. Sure, they're all interesting, but good luck keeping track of the plot lines. Stick to a focused list of companies you can monitor and understand. Remember, quality under quantity. 5. The case for dividend ETFs. If managing even 20 stocks feels overwhelming, let's simplify. Consider adding dividend-focused ETFs to your portfolio. Funds like SCHD, Schwab US Dividend Equity ETF, or VYM, Vanguard High Dividend Yield ETF, give you instant diversification and consistent payouts. For example, SCHD holds around 100 high-quality dividend stocks, and its yield is often over 3%. By owning an ETF, you're essentially outsourcing the stock picking and rebalancing process to professionals. It's a great way to complement your individual stock holdings, or even replace them entirely if you prefer a hands-off approach. 6. Reinvesting dividends for maximum growth. One of the smartest moves you can make is reinvesting your dividends. A dividend reinvestment plan, DRIP, automatically uses your payouts to buy more shares, compounding your returns over time. It's like a snowball effect. Your dividends earn dividends, and those dividends earn even more dividends. For example, let's say you own $10,000 of a stock with a 4% yield. That's $400 in dividends your first year. If you reinvest those dividends, your next year's payout will be even higher because you now own more shares. Over 10 to 20 years, this compounding can significantly boost your portfolio. 7. The importance of staying consistent. Finally, remember that building a dividend portfolio is a marathon, not a sprint. The earlier you start, the more time your investments have to grow and compound. Stay consistent by investing regularly, even if the market gets choppy. Reevaluate your portfolio every year, but avoid the urge to tinker too much. Patience is your best friend when it comes to dividend investing. So, how many dividend stocks do you really need to retire early? To recap, aim for 15 to 30 stocks to achieve the perfect balance of diversification and manageability. Focus on quality over quantity by picking reliable dividend payers with strong financials. And if managing individual stocks feels like too much, dividend ETFs are a fantastic alternative. Lastly, reinvesting your dividends and staying consistent are the keys to long-term success. If you found this video helpful, let me know in the comments how many dividend stocks you're holding or planning to add to your portfolio. And don't stop here. Check out this video on the best dividend earning strategy. Don't forget to like, subscribe, and turn on notifications so you never miss tips to grow your wealth. Let's build that early retirement dream together. See you in the next one.